Most people look at oil prices, but very few actually look at underlying balance between supply and demand, because that's where the real signal is. Welcome back to another episode of BI Edge. This is where I build market intelligence models focused on energy markets and macroeconomic trends. What I'm going to show you here is a global oil supply and demand model built using long-term data from 1984 through to 2024. Before we dive in, it's important to understand one thing. Global oil data is not perfectly balanced. Production, consumption, imports, and exports are reported differently across countries with timing differences, storage variations, and classification differences. So the goal here is not precision to the decimal, it's understanding the structure of the system. When we look at global oil production versus consumption, we can see a consistent trend. So here we've got our production versus consumption. Okay, we can see a consistent trend. Both have grown steadily over time. So we can see that they've both gone up there and increased exponentially over time. But importantly, production has generally exceeded consumption. Okay, so if we look at production here in the blue versus um, consumption in the yellow, we can see here that 1986 production was a lot higher. Okay, 1990 production was higher. GFC production still way higher. And then up here, COVID production way higher again. Okay, and then we sort of see some tighter years here between the two, but for the most part, there's a clear disparity between the two. Okay, so this tells us that structurally, the oil market has been oversupplied for long periods of time. Okay, because we are producing more oil or crude oil than we are consuming. Okay, so what does that lead? It leads to an oversupply in the market. Okay, so if I go back to my report, you can see here the market condition is oversupplied. Okay, and this data here again is from the EIA. Um, some of the realistically production and consumption should be pretty close together. This is 1984 and 2021 here on these KPI cards as well. So that's why they're a little bit out because there's some null values in the EIA data set. I'd say that exports there's probably got a few missing values, and that's why the global oil trade balance is off there. That should be a bit tighter than that. We'll move into our graphs and walk through that as we get through this analysis. Now, if we move into market balance next, okay, so this is the difference here between production and consumption. So I'm going to go in here to market balance. This is where things get a little more interesting. Even though the market is structurally oversupplied, the degree of that surplus changes over time. And when that surplus compresses, that's when we start to see pressure build in pricing. Okay. So we can sort of see here, these are the high years of the surplus here. 1992 was really high. Post Gulf War, really sort of knocked up there. A little drop for the GFC there, and then after the GFC went down again. Pre-COVID here in 2018 was quite high again, and then we see another drop down here, okay, in 2021 before moving into the war in the Ukraine over here, okay. So that's an interesting little trend there. Um, so next is if we overlay major geopolitical and economic events, we can see the disruptions there in market balance. And that's what we've got up here. Okay. So we can see the Iran war here. We don't have that data available from this source. Gulf War in 1990, we saw that, it was 14,872 there, million barrels a day. That's annually here for 1990. Gulf War and then global financial crisis over here, 20,000, and then COVID in 2020 here. All right. So, um, previous years was a down, previous year was a down, previous year was down. Okay. So it's sort of gone up in those years. We can see that these events often align with disruptions in market balance. Okay. Not always in direction, but always in volatility. So, afterwards, we can always definitely see volatility post geopolitical crises here. Now, next, we're going to talk to trade imbalances. Okay, so imports and exports don't perfectly match, and that's expected. As I sort of pointed out before, null values can happen in the data set. Some of the other factors here um, are differences in reporting scope, storage and inventory movements, timing mismatches across global markets. So rather than treating this as an error, we will treat it as a real world characteristic of global energy data. Okay, so we can sort of see here, massive drop here post COVID, but pretty tight there together for the most part here, especially in sort of more recent times. They've kind of both trended in the same direction, is what I'm sort of saying. There's a little disparity there between the two. Um, okay, next we've got price relationship. So when we compare oil price to market balance, so this is the market balance down here. So we've got the global oil trade balance here. So that is these two figures here, which is you can see here on the filters, I should be able to show you. No, that's not going to work. But yeah, basically what this is here is, if I click on this, yeah, this is the difference between these two. So 2006 here, yeah, 26,700. And I go 2006 here, that's the difference between 87K and 61K there. So, yeah, this is the difference between the two, which is the trade balance. So the market balance is the difference between market supply and demand. And the global oil trade balance is the difference between imports and exports. Okay. So that's what that's all about there. Um, so oil prices down here to market balance, that's this graph below. Yeah, we can see a clear relationship again here emerging. So when surplus is high, prices tend to be suppressed. And when surplus tightens, prices rise. Okay. So, when we look at the market balance here in, say, just before the GFC 2008, oil price was quite high. And the market balance was negative 12,000 there. Another time here when it was a bit lower, the oil price is 49 and the market balance was negative 14,000. Okay. So, yeah, we can definitely see that relationship there. And again, here, when the oil price is down, the market balance is sort of come up there from previous amounts. If we look at this here, we can almost see, a relationship here and then an upward swing. So there's no real consistent inverse relationship here. Over here, um, probably a little bit, but nothing sort of too sustainable there long term. So basically, when surplus is high, prices tend to be down. When surpluses tighten, prices go up. Okay, so if we look at the surplus here, that's a high surplus, and that's a low surplus there. So, low oil price 1984 on a high surplus. Um, you know, all through the 80s here, the oil price is down, and as a result of um, you know surplus being um, quite sort of significant there in terms of going up an upward trend. So the inverse relationship is one of the most important signals in energy markets. So that's what we want to look for here is the relationship between the two. When oil price goes is high, there's um, prices will be down, and when price tightens, um, when surplus tightens, and there's less available um, oil on the market, then prices go up. And that's sort of what we're seeing with the war at the moment. We're seeing much higher prices because supply has been damaged, because transport has become much more difficult, and certain refineries have been targeted. All right, so next we're going to go to key insight. So stepping back, the key takeaway is this: the oil market may appear oversupplied on the surface, but the real driver of price is how tight that surplus becomes over time. And right now, that buffer is much smaller than it was historically. So why does this matter? Um, Real implications here is cost volatility increases, pricing becomes more sensitive to shocks, risk management becomes more critical. The tighter the system, higher the stakes. So just before we close out here, guys, just a few things I want to go over here with the model. Down here, we can look at our different market signals here. So, when market balance compresses, low surplus, this aligns closely with oil price spikes, as just discussed. So, supply conditions were evident during the late 2000s, pre-global GFC and post-COVID-19 pandemic recovery. Oil prices show an inverse relationship with spare capacity. Lower surplus is higher prices. Higher surplus equals price suppression. So basically, it's just supply demand. So, um, lower supply of available oil on the market leads to higher prices, and a higher supply of oil in the market will lead to um, you know, a much cheaper based, a much more cost-effective price of oil. Okay, so more competition in the market, more countries producing crude oil leads to um, you know prices to come down. But then you've also got to factor in OPEC and all these other bodies that uh, basically have a say over or global oil supply. Supply versus demand trend. Global consumption has steadily converged towards production, reducing buffer capacity. The market is increasingly operating with less margin for disruption. Trade flow, global oil trade balance remains structurally negative due to reporting gaps, not physical shortages. That's sort of what we sort of talked about here between the imports and exports. Okay, so sort of how that went down there. Okay, so that's basically the dashboard here. This is the reserve percentage over here as to sort of what we've sort of had. So you can sort of see here that the reserve percentage was quite high here in 92, dipped down really low here in 2002, and then again dipped down after the GFC, and then dipped down again here post-COVID. Okay. All right. So the model is part of a broader framework building across oil, LNG, and global supply chains. If you're working in energy or commodities and want a better understanding of how these dynamics impact your business, feel free to reach out. I'm always open to feedback and discussion. Feel free to comment in the section down below.